Circle Internet Group's first full month on the New York Stock Exchange has already delivered the kind of drama most companies never see in a lifetime. Across just 5 trading sessions, the shares rocketed 83.2%, while the S&P 500 and the Nasdaq Composite barely budged, turning heads on Wall Street and in Washington alike. The surge is even more striking when you zoom out. Circle raised a shade over $1 billion in its June 5th IPO at $31 a share, implying an $8 billion valuation. Since then, the stock has nearly tripled, valuing the company at roughly $60 billion, almost on par with far older fintech names. Why are investors bidding the price into the stratosphere? The immediate catalyst arrived on June 17th, when the U.S. Senate passed the Guiding and Establishing National Innovation for U.S. Stablecoins Act, better known as the Genius Act, by a bipartisan 68-30 vote. It is the first time either chamber of Congress has advanced a comprehensive federal framework for dollar-pegged stablecoins. Circle matters because it is the sole issuer of USD coin, or USDC, the second largest stablecoin and the only one created entirely inside the American regulatory perimeter. Every token in circulation is matched by a dollar-denominated reserve, held mostly in short-term treasuries. So, the company's revenue comes primarily from the interest those reserves earn. With roughly 60 billion USDC outstanding, 5% short-term rates have lately minted cash faster than many Fortune 500 industrials. The Genius Act would widen the playing field. For the first time, banks, fintech platforms, and even large retailers would have clear authority to issue their own payment stablecoins, provided they maintain one-to-one reserves, submit to anti-money laundering rules, and open their books to regular audits. Crucially, the bill classifies payment stablecoins as neither securities nor commodities, shifting day-to-day oversight to bank regulators rather than the SEC or the CFTC. Before it can become law, the Senate version must be reconciled with the House's Stable Act. Negotiators need to settle, among other issues, whether the Federal Reserve or a newly created office at the Treasury will be the primary watchdog. If the two chambers strike a deal and President Trump signs it, as the White House has signaled he will, stablecoins will, for the first time, operate under a single nationwide rulebook. That prospect electrified crypto-focused traders, but lawmakers emphasized the consumer angle as well. Senator Kirsten Gillibrand, a co-sponsor, framed the bill as a chance to enable U.S. businesses and consumers to take advantage of the next generation of financial innovation, while simultaneously safeguarding the dominance of the U.S. dollar. The market's logic is simple. A clear legal path should increase demand for compliant dollar tokens, and Circle, as USDC's sole minter and redeemer, would capture a large share of that expansion. Under the Senate bill, stablecoin issuers must hold reserves in cash or T-bills. Every basis point shift in the Fed funds rate therefore ripples straight into Circle's revenue line. That linkage explains both the euphoria and the unease visible in recent trading. Euphoria shows up in the headline numbers. Since listing, the stock is up almost 200%, dwarfing most post-IPO rallies of the past decade. Unease lurks in the valuation math. Last year, Circle generated about $1.7 billion in sales. At $60 billion in market cap, the shares trade around 35 times trailing revenue. Growth will have to be extraordinary to justify that multiple once interest rates fall back toward historical norms. There is also the Coinbase wrinkle. Roughly half of Circle's revenue is paid out to Coinbase under a sharing agreement that depends on how much USDC the exchange holds. If Coinbase decides to prioritize other assets, Circle's cash flow could shrink overnight. In other words, Circle's fortunes hinge not only on macro policy, but on decisions made in conference rooms it does not control. Put these pieces together, and a picture emerges of a company perched at the intersection of regulation, monetary policy, and platform economics. The Senate vote launched hope of a regulatory green light. The Fed's eventual rate cuts could dim some of that shine. The behavior of a strategic partner might either amplify or muffle the upside. None of this negates the transformative potential of a well-regulated, dollar-denominated internet money, but it does remind us that rocket ship charts seldom travel in straight lines forever. For now, Circle embodies the market's big bet that Washington's newfound enthusiasm for stablecoins will translate into mainstream adoption. The coming weeks, House hearings, possible amendments, and the ever-present Fed whisper campaign will test whether that wager has legs.